Well, welcome everyone to our second Live in New York City podcast. It's the first of many live podcasts that we've done. I'm delighted to be joined here by Jay Jacob, who is a long-term friend of mine and allocator, 25-year plus veteran of the multi-asset investing arena. He has been one of the first to be thinking about AI in investing, which is why at this live event we are going to take a little bit of a different tilt from our usual programming and dig in a little bit more into some of the work Jay's been doing, ask you your insights about AI and investing and how it is disrupting the work we do, how it will disrupt the work we do. So what I am not talking about today is inflation, interest rates, geopolitics, equity markets and other asset classes. If you want to hear about our thoughts on that, you can tune into the podcast I recorded at 5 a.m. That will be stage one of the Markets Happy Hour for today. So this is Jay, and he spent more recently at Rockefeller Capital Management, but was previously 25 years at Lazard Asset Management. And what we're going to talk about, we're going to just do a quick snapshot as to where we are in AI thinking. It's impossible to cover that, even in the case that snapshot could take the entire length of the event here. But I think it is important just to take the temperature on where we are in AI thinking in markets. We look at some of Jay's work on how AI could transform investing across the different ways that we invest. We're going to look a bit about creativity, does it affect creativity? Does it enhance it? Is that what we need to be relying on now, is creativity? I'm particularly interested in fiduciary duty and how AI relates to that. The scale, the human capital challenges, global implications, and then finally we'll get very meta and look at the investment opportunity around AI. And all of that will be done in 30 minutes, which is quite an achievement. But first, just to get back to the topic, which I have as gardens and rain, which I think is particularly apt given the rain we've all just navigated to get here today, particularly drenching rain. The analogy comes from something that a competitor podcast, the All In podcast, which I don't often quote from, but I will say that they had a nice quote which was about, instead of thinking of the economy and the employment being like a pie that we divide up, that our portfolio is a garden and technology is the rain. And that if we think about AI as the rain, it'll make everything flourish, make everything do better. Just like technology enhanced everything else. So that's a particularly positive way to think about it. But I will, we will take it from there. But very quickly, just to bring us up to what I'm seeing in AI in markets, we all saw the Citrini 5,000-word essay, the dystopian reality that it painted. I think that the fact is that this is just one of many potential outcomes in a funnel of outcomes. We could be looking either at AI having no impact, AI basically leading to human extinction at one extreme, or the end of scarcity and overall abundance at the other. So I think that is sort of part of the thinking that we've had. We're talking about the explosion in coding productivity. This morning's podcast, I talked a little bit about space and that's where all the next infrastructure build will be carried out. Positive kind of input there. And then I think the issue is how much are we, the ordinary, and I count myself as very much an ordinary person and not a coder, not an AI specialist, how much are we actually using it? Because I seem to have gone down some Twitter rabbit holes whereby there's a suggestion that everything, my workflows can all be sorted, and if I don't understand how Claude can help me, all I have to do is just look at that. I mean, I don't know about you, it's small, but I can tell you it's completely impenetrable for the average non-coder. So if that's my solution, clearly I need a guide to navigate through it. So over to you, Jay. First of all, maybe can you give us your thoughts as to where we are in this zeitgeist, I suppose, around AI, and then how you think about using it in investing?
Well, I mean, I think that there are many different angles to it, and a lot of them are still being conflated into one conversation. There is certainly like an investment angle directly in the companies that are pursuing the technologies themselves. Then there is a picks and shovels kind of enablers and infrastructure, all of the hardware that's required. And then behind that, which is probably the safest part of the story, is the energy consumption. It's crossed over 4% of US energy consumption now on data centers and things like that. So there are different layers from that perspective, but I thought one of the things that investors, I don't think spend enough time yet considering is how does it change what we're actually doing? How does it change an investment process itself, right, as opposed to the investments. And I think that a lot of process automation that we're seeing has required that we start becoming, I think, a little bit more philosophical about what we actually are doing and how we would automate it. Because the industry has been, I think, cut into many different portions because of regulation. I think the concept of customization was largely washed out in the 50s. I think post-World War II, you had this real focus in every industry about mass production. And I would say that that led to things like the mutual fund. But these norms, I think, are slowly being eroded, because we do have this moment now where there isn't really a need for anybody to have a mutual fund per se, because the chances that a collective vehicle will meet the exact needs of any one of its contributors is actually quite small, right? And the reason not everybody has a custom mutual fund right now, to me, is just a technological problem that can be solved.
So I think to get there, I'd love to move on to the 8 verbs of investing. But I thought this was intriguing because we have just come up with this disruptive effect of the altruist in the private wealth world, altruist with this tax planning software being about to disrupt our world. We saw that fall off a cliff. We saw banks affected. And I don't think people actually stop to say, well, how is AI actually going to affect the craft of investing? And what I thought was really intriguing is how you have broken down the crafts of investing into verbs, into what we do. And if you actually look at how it affects and is likely to affect every aspect of what we do, that I think is how you end up really parsing what the impact could be. So could you take us through this and how
Sure.
you came about this step-by-step approach?
So, you know, the way it came about was a bit interesting. When I was at Lazard, began a data science group. And one of the things, and this was probably in 2015 or so, and the data science group was populated by individuals from non-financial fields, all very bright folks, much smarter than I will ever hope to become. And they were from different industries, and one of them was from neural imaging. His previous job, he was a PhD in physics, and he would take sensor data and recreate 3-dimensional models of human brains for use in surgery. And so he came to ask me, you know, what is it that you want us to do here? And I said, you know, you're here to enhance our investment process. And he just said, you know, I don't know what that is. And then I started hearing myself kind of reciting standard marketing PowerPoint jargon. And he said, can I just see the presentation from which you're quoting? And so what I ended up doing is I said, look, here is a whole file system filled with presentations about investment processes from different asset classes, and, you know, take a look at it. And of course, he automated that process. He concluded that investing seems to be mostly determined by what version of PowerPoint was available to the authors at the time of the investment process, which I thought was, you know, a bit too close to home. But ultimately, it led to this conversation about, well, what are you actually doing, right? I mean, there are all kinds of funnels and arrows pointing to one another and things like this. What are you actually doing? And this ended up being a really long conversation before we kind of said, all right, what is investing? It starts with this observation, right? And you can look at this as a quantitative exercise or a data-driven exercise, or you could imagine a fundamental investor doing very much the same thing and then just using her own brain to kind of get there. So I think if you start with observation, that could be any of the data that the world has. Now that is exploding, and you've seen those charts just going parabolic in terms of what do we consider data. Data is not just tables, it's this conversation, it's every interaction that we can record. And from those observations, we form some kind of a belief, right? That is a prediction about the future in the end. And that belief then, in order to become more tangible, and this was a very controversial step, is we really have to categorize the belief into smaller buckets. You know, it's one thing to say, well, I think developing economies are going to grow faster than developed economies. But until you kind of untangle that mess and say, well, this is why, or these are the 3 areas, I think. I mean, you know, the rule of threes has a good origin story in investing as well. So I think in categorization, you have to take a broader topic and parse it into smaller subtopics. And that is actually when a lot of the communication starts to come alive. It's typically when I think that the most humans begin to understand things when they see it broken down, at least into one level. If you get too fine, it becomes a bit confusing. And so suppose you might have 3 or 4 categories, then you get into the more day-to-day process of investing. Qualify is a step in which you'd say, what is every possible thing I can do now? What am I allowed? What am I legally permitted in the case of an investment? What am I permitted to invest? This could be something as simple as screening, but a lot of the historical screening exercises have really relied on shortcuts because of that mass production concept, right? We say, okay, well, I'm only going to invest in large caps in the US or something like that, or equities or whatever it might be. So that's another area where you're seeing, I think, quite a bit of work done. And then the meat of it is analyzing. If I'm going to now take everything I can do and reduce it, in some way, I am going to have to analyze, typically using multiple modes of research, every one of the choices, right? Now, in quantitative investing, everything has to flow through the funnel, as they say. In fundamental investing, a lot of people simply just ignore many of the choices that are available. But ultimately, so you might look at it, so maybe a research analyst goes to visit the company and they reach some conclusions. A quantitative analyst goes through the income statement, the balance sheet, decomposing its returns into factors and things like this. It could just be a company that you really happen to like. These are all different modes of research that ultimately need to be brought together and ranked. So you have to say, all right, well, do I want to listen to the fundamental version of this, or do I want a quant factor, whatever it might be? This is a factor loading step in quant speak, but all investors have to do that. They have to take the different modes of analysis and condense it down and end up with a list of things that you like the most down to things that you like the least, right? Now we introduce risk into the equation, and if I've gone through this exercise and I find that the top 10 investment ideas I have are all Turkish banks, I'm going to have to make some adjustments for that at some stage. And either that's done intuitively, which is, I would say, how it used to be done, or it's done with a formal risk model of some kind. But ultimately, now you're saying, with what proportion am I going to allocate this capital? And then finally is the act of executing. I have to now commit that into a trade and build a portfolio. So we went through this, and I know it's a bit of a long walk through those steps, but it should be the case, and this was the test that we had, that if these are actually the 8 verbs of investing, then any existing strategy or any existing approach should be able to be reduced and broken down into these steps. And we had luck with that. We found that you could look at an existing portfolio that could be 100 years old, and you could break down what is happening. Once you do that, some of these tools that I would say AI broadly, that covers a very large swath of automation tools and capabilities, now you can start figuring out how is this actually helping any one of these steps, right? Because there's a lot of capital being thrown at AI in general, and we're still not at that point where it's clear what is going to happen, right? And so for people making investment decisions, I really always encourage them to just you may disagree with these verbs, you may have the other ones, but don't get distracted by adjectives because those will change. We're not going to know. We don't know exactly what the specific technologies that will be deployed, how they'll develop, but if you've been able to articulate the investment process in a disciplined fashion, then I think each of these steps you can bolster. Right? And AI is doing amazing things with each of them, starting with observe all the way down to commit. Each one of these technologies having an impact, but they won't all be impacted at the same time. And so keeping that modularity of the approach is key.
This I thought was a really interesting point, because I've been wrestling with this as well. It's like, where is the AI going to help? And Jay is here, the other Jay, who is focused on venture capital. Mm-hmm. For example, does AI could it help with origination in the venture capital side? Maybe that could be very helpful in terms of really trawling through all the information of every sector, but can it be helpful in deciding and evaluating, or whether this is a weighing or a ranking, whether this is a founder you would want to back? And is that the human side?
The human side is very subjective, and we spend an enormous amount of time on that because we're investing with companies that are in their nascent stages. But the ability to distill the output from our own research and the ability to use AI to categorize and to help us identify areas that we might want to pay attention to, even as simple as looking at term sheets and analysing what's standing out here that is a red flag. I think there are many ways it can facilitate the process. I don't think we've got to the point where it eliminates the human input, but it certainly helps.
Right. I know Vidak has joined us here, who is Beryl Consulting. Yes, Vidak has good to see you. Who does a lot in terms of AI. Do these steps seem like ways that you would analyze your data sets, and how have you seen AI as useful for in your practice? And
well, we actually host few conferences, and we always integrate AI. So it could be healthcare, it could be life science, it could be lots of hedge funds, private equity, venture capital. So I like this process. It's really interesting. We don't do it that way, but it's very interesting.
Yeah. It's and I think what I had asked Jay immediately was on the fiduciary side, because I think that it gets to the judgment around character, but equally whether AI could be moving to the board level. Where is the real expertise that we wish to pay for? And this will eventually, we'll talk about this in the human capital development side, because this is skills around either judging venture capitalists, judging when to exit a stock, or when to be on a board and when to assert yourself from a governance standpoint. That's very much a human skill. Do you think AI can provide a role or have a role in, say, a board of directors?
So this was, when you mentioned that the other day, as I said at the time, that just set my mind racing, thinking about board meetings that I might not be required to attend. That was actually quite fascinating. I do think so. I think that, the way, and here specifically with large language models, they're dependent on the corpus of information on which they've trained. And I think one of the interesting developments that you've seen, it really started with consumer focus groups, right? Where, and a lot of the major food and beverage companies do this type of thing, where they'll train a model on a particular set of documents, and then they'll train another model on another set of documents, and they'll literally have them argue and debate. And I think I am still very much a human in the loop believer, that debate is basically useless unless there's a human who's alongside it. But I could certainly see in a board situation the utility of having, different almost personas, maybe a skeptic, maybe something like that, where, pick apart the logic of this argument. Those models should do quite well there. How you integrate it in the social fabric of a board is a totally different question. That's quite interesting as well. But I certainly think it can be useful in that sense.
It's interesting because I think one of the hardest things to do as a board member is provide challenge, because that's the conflict, that's the human aversion to conflict, to speaking out. There can be imposter syndrome that's experienced by board members, or just general piggybacking on a consensus. So AI could be the classic devil's advocate, but I think we know in any situation where we assign someone a devil's advocate, it's not really authentic. So it kind of gets underweighted then for that reason. So whether AI would be afforded less weight because it's the token AI contributor, or whether it gets more weight because it is the omniscient, all abundant intelligence, has seen it from every angle, doesn't bring emotional baggage to the table.
It could. I mean, in that, I think that as we've seen communications technology and its evolution in the last 15, 20 years, it has certainly meant that more meetings of people or gatherings or media are happening in echo chambers, right? And yeah, in many ways, I think, and effectively what's happening is human minds are effectively being trained in their own corpus of data, whether it's political or even in economic theory. You tend to just listen to the things that you agree with. And I think these models are able to look at both of them and as you say, be much more objective about it.
And one of the other areas, when some people here have been lawyers in the past life, or and even on the venture side, a lot of the value is added in the negotiation. Whether it's negotiating the term sheet, whether it's as a lawyer negotiating a contract, negotiating a price, negotiating terms. Have these models been tested as negotiators, and could you put the models against each other, the two agents, just like we had on Mold Book, everybody socializing together, building religions, conspiring? Could you put two agents together to just crank out a contract and come out with the best set of outcomes?
I mean, I think so, but I wonder, I haven't decomposed the verbs of what the negotiation would really entail, right? Because I think finding a middle ground and that could be very interesting, but I think that requires a separate deconstruction along similar lines about, because many of the steps may not be needed. You know, if you think about, again, to go into something, a mundane example from our industry, is the RFP process, right? So once large language models started becoming a bit more mainstream, everyone said, oh, this can automate the RFP process. And not that it can't, but the reality is now you've got an AI-generated RFP being read by another AI. It doesn't seem like the RFP is a necessary step. That is not the most effective way of communicating between two machines. And so I don't know. I mean, it's a very long way of saying I don't know the answer to your question.
Well, I think this gets to how you summed up with we're not necessarily summing up the podcast here, but summing up the thoughts on those 8 verbs, which I'll let you read in your own time, but we can share these after. But it seems that it can improve every stage. It says you can elevate every of these eight steps, but that human accountability, trust, responsibility remains at the core. And I suppose you could say, well, we would say that, wouldn't we? I mean, that's our mission is here. I know not everybody here is in our industry, but it'd be interesting if you have feedback on that. Do you think you would trust an advisor delivering the robo, or would you rather the human? I think this is a nice way to sum up in terms of portfolio management. How does this presentation land? You've given it a few times. Do you get heads nodding?
So it's interesting because it's evolved. I mean, the verbs have stayed the same, but the techniques that could be applied have changed drastically in the last 10 years. There is, I think, an interesting, and I want to respond to the navigating through traffic using local knowledge, because I think that's a very interesting puzzle. To me, that is just a matter of having more data. We don't necessarily know how to record and encode that local knowledge yet, but I think we're not far from being able to do it. But the other problem, and this is almost back to the heart surgeon, is what are the real motivations that are behind the algo? And this is where I think the accountability has to still be there. And for this, maybe I'll switch metaphors to a plane. You've got a pilot who's using a lot of automated systems, but the pilot is still in the plane. And the question then becomes, would you rather have an automated pilot or a pilot sitting there? And to me, I think one of the interesting things about a pilot sitting there is that the pilot has quite a bit of skin in the game. You know, a pilot who is piloting a remote craft does not have that much to lose. And I think that, as a passenger in a plane, that's something that we always have to be very cognizant of, right? And so when I look at a lot of these systems, I think it comes down to, is it an autopilot making a light flash red, telling the pilot turn left, and then the pilot looks out the window and says, like, no? Or is the plane itself simply going to be turning left with the blinking light? Part of it is taste. Some people, I think, would prefer the discipline of a plane that's just turning itself. There's a fallibility to the human that is, a lot of the self-driving car debate is about this, right? Where, well, humans are terrible drivers, and they're killing other humans at a faster rate than the machine. But the real question is, well, who just killed that person if it wasn't a driver? Was it the coder who was sitting there and had a bad day and forgot one line somewhere to catch a certain condition? And the life and death metaphors are obviously, it's less extreme in typical financial markets decision making, but I still think that the legal structure that we have set up around fiduciary authority and accountability, that still matters.
Absolutely, and that exactly gets to the point, I think, around whether it's the fiduciary duty or whether it's the reason we hire auditors. Do we hire auditors to do sums, or do we hire them to sign off on their opinion? And we know that that's where the buck stops. And I think, again, this accountability around decision making, and think about what we've recently seen with private credit in terms of some individual groups. I think their employees have been asked to chip into the fund to ensure the redemptions can be made out of the fund, the ultimate skin in the game. Mm-hmm. And we've always asked that in every private asset unit. What is the GP's stake in the outcome? And you really want to see participation, because that's when you know that there is going to be that accountability. And right now, I think that the same would probably come for employees. When you spend time training employees, you have skin in the game of their outcome. Equally, are you training employees simply to do your PowerPoints and do your Excel modeling, or are you training them in order to be the next generation of talent? And equally, to learn those skills of accountability that we ultimately expect from our professionals. That's another conundrum, I suppose, around the human capital.
Absolutely, and there are different. If you were to plot sort of the careers of, say, you make an arbitrary definition of success, and you put them versus the age of the individuals, right? I suspect that you'd see a fairly consistent line that goes up with seniority or success and age, with a couple of outliers for some boy genius who starts a company or a startup like that. There'll be some of those too, but that could be disrupted pretty significantly by this, right? Because if you think about it, what are we, when we first begin working, we're basically fabricating blocks of labor of some kind. And then if you're good at that, you get to design the blocks. And if you're good at that, then you get to stack the blocks. And eventually you can build structures with labor. I think that the ability to come up with good structures with labor is dependent on some degree on your ability to understand all of the pieces that came into it before, to understand how, having gone through the process oneself, one has a different appreciation for the unit of labor that you're stacking. And I think the curiosity that develops with expertise is something that's definitely at risk. Mm-hmm. Right? Because it's not clear that somebody who has grown up in this era would be able to ask the same kind of questions, because their experience will be that different. They may ask much better questions, I will concede, but they may not. Yeah. And that speaks to that apprenticeship model and what happens to it if you don't have a junior person.
It was with the podcast this morning, I asked about someone's pathway into investing, and he talked about going through an internship that almost burned him out, because it was in an investment bank and it really was almost the end. And it made me think, it's not just the apprenticeship. Some of this is almost like a hazing at times that goes on. And it seems like maybe it should be obliterated, and we should all be having better work-life balances. But that hazing, I would suggest, is a necessary building block of resilience, because it takes a fairly strong stomach to be an operator in financial markets and to go on risk and to deal with that not in the stomach feeling, which we've all felt when something starts to go against us. And I would suggest that resilience is built over time as well. And not that the machines will maybe suffer from depression or weakness or weak conviction, but if we have no humans left who have got that resilience, that could also be an issue. I have a very mundane use of AI up here, but this is what the headlines of the financial press will tell you. Guess what? People are using AI to screen for ethical. Well, that's a very obvious use case, I would think. I don't think there's anything particularly groundbreaking about that.
Well, I mean, think about it from those verbs. It's changing what is qualified, right? It's taking an observation and it's saying, what am I allowed to invest in a different way? And again, I think with the right modular design, it can be very powerful, right? It really turns into a set of tools, a set of, say, complementary Lego bricks that can be put together in different ways to create very customized outcomes. Because, I think ethical screening or ethical issues or ESG broadly written, I think these are subsets of customization in the end, right? It's that I would like, and this is, you could see it in the way media has evolved as well, I would like my portfolio to be reflective of me, just as I'd like to share my Netflix list or my who I follow on Twitter or X or whatever. Those are all, I think, developments that are moving away from the era of mass production and into one of hyper-customization. So I absolutely think that, especially that to me says qualify and categorize, right? And it's quite good at that.
Super interesting. And I think when you combine that hyper-customization with the actual tools behind the scene to tokenize, say, venture capital or private credit, private things that were not traditionally tokenized, that's when you can start to actually slice and dice and deliver a customized portfolio.
Absolutely, and that's a huge topic, right? I think that if we consider what, and Vikram and I, we were talking about this the other day, what happens when private equity deals are on a blockchain and just can be decomposed and exchanged? that's a pretty major moment. And that allows people to take very small fractional exposure in very complicated deals, right? Or for the VC world, which to me, one of the fascinating things that I have about, and I have no idea what the answer is, I've always wondered, how do you even know what you're allowed to do as a VC? You could do anything, right? There are so many possible investments you could make. How do you even go through that process of winning it down? In public markets, it's fairly easy. Here are the 3,000 things that are listed for you. Pick among them. But yeah, I think these are all areas where you could see significant developments that will open up a lot more of the capital markets to many more people.
Well,
These are the positives. What about negatives? What happened with Block and 40% of people laid off, and then the people who stayed, they gave them raises. So, any viewpoint from your end, from your company?
I think that it is the case that right now this form of almost intellectual automation is definitely, the benefits are accreting to capital and not labor. And you're seeing that as they say, the K-shaped or whatever metaphor you'd like, but it certainly is the case that capital is the winner right now. There are nice philosophical statements you can say about, yes, but now everyone can be one of those, but until that happens, I think it's definitely a labor shock that's waiting to occur. It's already starting to occur, frankly.
I would just add in the recent SaaS apocalypse, as it is being referred to, there's an imbalance because CFOs are contracted with Salesforce. They're contracted with all the providers of B2B SaaS that they've been using for many, many years at this point. They may have been overvalued, but those are contracts in place. Is Anthropic's ability, is Claude's ability to code going to suddenly replace? But they're spending on AI as well. So CFOs are currently spending across the board.
Absolutely.
But how much of it do they need, and what's the ROI? So I think we're at a pivotal point in the high tech.
Well, that's an excellent point. I mean, it's not as if the decision around capital or labor has always been made in an infallible way. I mean, in fact, that's the way where there's been constantly overhiring, overfiring, boom bust cycles, always find them short staffed, and it's highly inefficient. The amount of value that is destroyed. If AI could be applied to that HR algorithm in terms of who you're planning out into the future. And I think these are exactly the kind of example of human error, whether it's favoritism, it's anchor bias or recency bias or just whatever it is. But so I think that this is a real issue. This kind of gets to the point of investing in AI because we are at a point where we're also trying to make money out of this or have our clients make money or avoid over concentration. And one of the points around with Block was rewarded significantly for those headcount cuts.
Yeah, I wonder if there is any company that is doing forward-looking rating of who is more forward AI company. Is there American, U.S. and financial guys, they love to do ratings, anything, right? This is the country of ratings.
I'm sure it's out there. Another to quote again from the All In podcast, Ray Dalio was on a recent one. He made the point that we know AI, the technology will be massively impactful. What we don't know is which companies will actually benefit from it. There will be winners and losers.
For example, forward-looking.
Yeah, so exactly. Yeah. We need to divorce the two. So there will be winners, there will be overspend. Apple has spent virtually nothing on AI. It's going to be using Gemini essentially that looked like a laggard and now it looks like a winner because it hasn't got the CapEx. The CapEx is getting concern. So really, really great point. This has been fantastic. Yeah, sorry, go ahead.
Consider that huge amounts of money are very rarely spent in the optimal fashion, right? I mean, if you think about, I go back always to thinking about in the second Iraq War, the U.S. was, they basically had said that they were going to rebuild the country. And then there was one article about how they had lost $1.4 billion of cash in a plane. But that's what happens when you have massive amounts of spend. I thought the DeepSeek moment was a real wake-up call because there were a fraction of the actual spending using what effectively was a pretty clever, you go back to this sort of space race and how do you now make a satellite land? You have very limited things you can do because it's out in space, and the innovation that is forced upon you by scarcity, I think typically is what is the most transformative. And
Yeah.
now it's just, I mean, the amount of money being spent, I can't imagine it is all going to the optimal use.
Yeah. Thank you so much for sharing the very
Oh, thank you
detailed
all.
breakdown of the verbs of investment management. Fantastic, groundbreaking work you're doing, and thank you for forcing us to think on so many different dimensions.
No,
Thank you all for coming, and hope to gather you again soon.
Thank you.